Most traders believe that risk management is a technical skill. They think it is about numbers, about position size, about stop-loss placement, about percentages. And yes, those things matter, but they are not the real problem. Because if risk management was only about numbers, most traders would already be consistent. The real challenge is psychological. It is not knowing what to do, it is doing it consistently. Because even when traders know their risk rules, they still break them. They move their stop-loss. They increase their risk after a winning trade. They take bigger positions after a loss to recover quickly. And in those moments, logic disappears. Emotion takes control. So the real question is not how to calculate risk. The real question is this: how do you think about risk in the right way? How do you train your mind to accept uncertainty? How do you think in probabilities instead of emotions?
Because once you understand this deeply, your entire approach to trading begins to change. You stop trying to control outcomes, and you start controlling your behavior. In this video, I want to explain risk management psychology and how to think in probabilities like a professional trader. If you stay with me until the end of this video, you will understand why most traders struggle with risk, how probability thinking transforms your decisions, and how you can build a mindset that stays calm and disciplined even during losing streaks. And if you want to continue building a strong trading mindset, consider subscribing to Bull Mindset. This channel is focused on trading psychology, discipline, and long-term consistency. Now let us begin with a simple truth.
No trade is guaranteed. Not one. No matter how perfect your setup looks, no matter how confident you feel, no matter how strong the trend appears, every trade has uncertainty. But most traders do not truly accept this. They say they understand it, but they do not behave like they understand it. Because when they enter a trade, they expect it to work. They expect the market to move in their favor. And when it does not, frustration appears. This expectation is the root of emotional trading. Professional traders think differently. They do not expect any single trade to work. They expect their system to work over many trades. This is the foundation of probability thinking. Now let us go deeper. What does it really mean to think in probabilities? It means understanding that trading is a game of outcomes over time, not a single event. Imagine a simple example.
If you flip a coin, you know there is a 50% chance of heads and a 50% chance of tails. But if you flip it once, you cannot predict the result. It might be heads, it might be tails. There is no certainty. But if you flip it 100 times, you expect the results to balance out. Trading works in a similar way. Your strategy has an edge, but that edge only becomes visible over a series of trades, not in one trade. Now here is where most traders make a critical mistake. They treat every trade as if it must be right. They become emotionally attached to the outcome. They want to win every time. They want to avoid losses completely. And because of this, they start interfering with their trades. They move their stop loss. They exit trades too early. They increase risk to recover losses. All of these behaviors come from one problem: not thinking in probabilities. Now let us talk about why the human brain struggles with this. The brain is designed to avoid pain. It is designed to seek certainty. It wants to feel safe. So when a trade goes against you, the brain reacts. It says, something is wrong. Fix it. Avoid this loss. Do something now. This reaction is natural, but in trading, it is dangerous because reacting emotionally destroys discipline. Professional traders understand this. They do not try to eliminate emotion. They manage it. They rely on structure. They rely on rules. They rely on probability thinking. Now let us talk about how thinking in probabilities changes your behavior. First, it reduces emotional attachment. When you truly accept that any trade can lose, you stop taking losses personally. You stop reacting with fear. Second, it improves consistency. You follow your rules regardless of recent results. You treat every trade the same way. Third, it builds long-term confidence because you trust your process, not the outcome of one trade. Now let us move into real trading examples. Imagine a trader who takes a trade. The setup looks good, but the trade moves slightly against them. Immediately, fear appears. They think this trade is wrong. They close the trade early. Later, the market moves in their direction. This creates frustration. This is emotional thinking. Now imagine another trader. They take the same trade. The trade moves against them. They accept the risk. They allow the trade to reach the stop loss or target. They do not interfere. Over time, this consistency builds trust.
Now let us consider another situation. A trader experiences 3 losing trades in a row. They feel pressure. They want to recover quickly. They increase their position size. They take a low-quality trade. That trade also loses. Now the damage is bigger. This is the danger of ignoring probability thinking. Now imagine a disciplined trader. They experience 3 losses. They do not change their risk. They do not change their behavior. They continue following their system. They understand that losing streaks are part of trading, and over time, their edge plays out. Now let us talk about another important concept: Risk management is not about avoiding losses. It is about controlling losses. You cannot remove losing trades from trading, but you can control how much you lose. This is what keeps you in the game. Many traders do not fail because of bad strategies. They fail because of one or two uncontrolled losses. Professional traders understand this deeply.
They protect their capital at all times. Now let us talk about mental frameworks that support probability thinking. The first framework is process over outcome. After every trade, ask yourself one question. Did I follow my plan? If the answer is yes, it is a good trade, even if it lost. The second framework is acceptance of uncertainty. You must accept that you do not know what will happen next. This removes the need to control outcomes. The third framework is consistency. Every trade should be executed the same way. This allows your edge to work. The fourth framework is long-term thinking. Trading is not about today. It is about many trades over time. Now let us talk about practical exercises to develop this mindset. One powerful exercise is fixed risk per trade. Decide your risk percentage and stick to it, no matter what. Do not increase risk after wins. Do not change risk after losses. This creates stability. Another exercise is journaling. After every trade, write down your decision. Did you follow your rules? What did you feel? Over time, patterns will appear. This builds awareness. Another helpful practice is reviewing trade series. Instead of focusing on one trade, look at your last 20 or 30 trades. This helps you see the bigger picture. Another exercise is mental conditioning.
Before you start trading, remind yourself, any trade can lose. My job is to follow my plan. This prepares your mind. If this video is helping you understand risk management in a deeper way, consider subscribing to Bull Mindset, because thinking in probabilities is one of the most powerful skills in trading. Now let us talk about something deeper. Risk management is not just about protecting money. It is about protecting your mindset, because when losses are controlled, your emotions remain stable. But when losses become large, your confidence is damaged. Your decision-making becomes emotional. This is why professionals focus on risk first. Profit comes later. Now let us move toward the final message. You will never remove uncertainty from trading. You will never predict every move. You will never avoid every loss. But you can control how you respond. You can control your risk. You can control your behavior. Let me leave you with one final thought.
You do not need to be right on every trade. You need to be consistent across many trades. Think in probabilities, trust your process, control your risk, and over time, your discipline will create your results. And if you want to continue building that mindset, subscribe to Bull Mindset. I will see you in the next video. Thanks for watching.